So basically here, we are trying to understand how banks, or in general, how financial system can create money supply. And why this question is important. Okay, to help you understand that, just think about the following scenario. This is number one, step number one. Just imagine, now suddenly, so we live in a world, everything must pay cash. Okay, how your life is going to differ. How your life will be different, right? So that shouldn't be difficult to imagine, right? So if everything must pay cash, meaning so first you have to save. Otherwise, where the cash coming from, right? So you have to save, and then I guess most of the things you consume right now, you will not be able to afford, like saving them including the college, right? So the bank generate money supply, and in a broader sense, generate credit, and then allow you to consume like ahead of your future saving. So that's kind of the story, right? But intrinsically or inherently, so this money supply generation process is going to create some risk. What's the risk? So look at this example. Silas started with 1,000 cash, and he doesn't need the cash, right? To keep at home is not safe. And plus, it doesn't bring any value to him. The easy way for him to do is just deposit the bank, deposit money in the bank so that he gets some interest, even though it's low, but still there's some interest. And plus, he doesn't need to worry about, someone to steal his money. Now, but certainly here, which is assumes the bank is safe. But is the bank safe? Not really. Now let's see what is the problem. So bank take $1,000 from Silas, and the bank is not going to sit on the cash. What bank is going to do is going to lend out, and usually higher the risk, higher the return, right? Because most of us study business, so you understand. So the relationship between risk and the return. Does that make sense? Okay. Now, furthermore, so this risk is going to bring some trouble to the banking system. Now let's see what happens. If the bank lend, like in this example, bank lend out 900, meaning the bank only has 100 as a reserve, right? So not just imagine Silas has some emergency, either as a car accident or some emergency, I don't know. So for example, he has to pay for his college, something like that, all right? Right. And then he probably just come to the bank, want to get the cash. But what the bank only has $100, right? And then, so what the bank is going to do? So the bank has a couple of options. Option number one, go to the debtor, whoever took loans. But usually this is not going to work, right? Because usually it's the reason why people take a loan is probably have a long-term or mid-term project. So this is not liquid, right? And then alternative, what the bank can do is to what? To sell the loan to other banks so that I get cash at a discount, right? But now you can see, so intrinsically there's a risk, right? Because just what's the risk? So when someone walks into the bank doesn't have enough cash. But this is an oversimplified model. But in reality, what happens is the bank is going to have 1,000 or maybe 1 million customers like Silas. And usually only 10% or maybe like 5% of the customer has the emergency on a database, come to the bank. And the bank has 10% or 5% of reserve. And even though, so this guy shut off, it's not a problem because they always have the cash to what? To hand to their customer. Does that make sense? But now what happens is if there's like a systematic problem, like in recession, so then the people walk into the bank is more than usually it can handle. Or even though there's no systematic risk or no recession, but then there's like a rumor, people say, oh, so this bank is going to get in trouble. And then so suddenly the rumor is going to spread, like what do we call it? Network effect. And then the people walking the bank is going to more than it can usually handle. And these things are going to become the virtuous cycle, right? Because the more people come to the bank has more pressure. The more pressure the bank have, and then it's on the surface, the bank looks more weak or more problem, right? And then you're going to get furthermore people comes to the bank trying to get the cash, right? And then what the bank can do, just don't look too far, just look at the Silicon Valley Bank, and then so the other one is First Republic. What's the name of the bank? Do you know what I talk about? Do you? Right? Okay, so then so this bank becomes bankrupt, right? But this bankruptcy in the one bank is going to spread to the other because banks are connected, right? To summarize, now we can see so the value of this banking system, but we can also see the intrinsic or the inherent risk in this banking system, right? So this is the two sides of the same coin, but this just naturally brings to the next discussion. So the banking regulation, right? So that's what we're going to discuss today. But first, make sure you understand. So the benefit and the potential risk brought by the financial system, right? So we already seen this. Okay, so now let's skip this. Right, so this kind of we just summarize what we just discussed, right? In the middle is currency in circulation. What is that? Literally, you can understand that as the money printed out by the Federal Reserve, right? Well, by the way, I think I made a mistake last time. So when Federal Reserve print out money, so this money doesn't go to circulation directly, and usually goes as follows. So the sensitive say, for example, the Federal Reserve print $1 trillion like cash, all right? And then usually what they're going to do is they're going to buy stuff. Like usually they're going to purchase, okay? So usually they're going to purchase the bond or treasury bill from the Treasury Department. Now what happens essentially, so the Federal Reserve is kind of swap the cash they have. They just print out with the bond or the debt the Treasury Department issue. Now the Treasury Department has $1 trillion of cash. What they can do with this $1 trillion, what do you think? So the Treasury Department, so essentially is a part of the government, right? So with Treasury Department with $1 trillion, what they can do, so they can either just give the money to like a different government, like pay the salary of the federal employee, or to give the money to the president. So the president can use the money to do whatever the government spending they can do. But that's usually goes through the Treasury Department. Is this clear? All right. Okay, so the Federal Reserve print the money, we call it currency in circulation, right? And then the currency in circulation is going to generate bank deposit, right? So now we understand how we get the bank deposit, right? Like in the previous example, Silas, just think about, okay, so how we start the story. Silas, you can think about he works for the Treasury Department or work for the federal government. And the Treasury has cash. The cash comes from where? The Treasury Department actually just sell $100 of bond to the Federal Reserve. That's how they get the cash, right? And with what this $100 of cash, the Treasury Department can pay Silas in the previous example. Now Silas with this $100 and then he deposit in the bank. But the bank with this $100 is going to multiply, right? Because the bank only need to keep a fraction, which is called bank reserve. Is it clear? Right. So that's why in the middle you have currency in circulation. And then on this bigger part is called checkable bank deposit, which is through the money generation process we discussed in previous slides. And then so here we have bank reserve. You have bank reserve, right? So the bank reserve is just essentially for each deposit, the bank attract the bank has to what? Has to set aside a fraction. This is kind of a safety. Is it clear? Now just imagine if the bank reserve requirement reduce, how would that change? How would that change the picture? Let me ask you again. So if the reserve requirement decrease from say become 20% to 10%, how this picture is going to change? Yes. Which one's getting smaller? The left-hand side. So basically, this part is going to get smaller. And now what happened? This part is going to get bigger, like a balloon, right? So on the other, vice versa, if the bank reserve requirement increase, now this part is going to get larger. So the bank needs to set aside more reserve for safety. Meaning, so the economy or the bank is going to generate less money supply, right? Just think about extreme case. Everyone must pay with cash, all right? And then there's no bank, so basically, so the check for bank deposit becomes zero, right? So that's extreme case. Now from here you can see, so that's the one critical thing. The central bank can regulate our economy. By how? By changing the reserve, right? If the reserve increase, money supply is going to decrease. Reserve decrease, money supply is going to increase. All right. So this is what we already discussed, right? So reserve ratio multiplier. Now let's see. So how the central bank is going to regulate. But now we understand so why the central bank need to regulate, right? Just think about, okay, just think about the case of the Silicon Valley Bank, right? Or in general, any bank, right? So if the customer comes to you and you don't have enough cash to pay, right? And that's a problem. Okay, in the worst case scenario, then you have this, what we call the bank run. Okay, again, don't look too far to look at what happened in Silicon Valley Bank. Okay, I do have a picture, but somehow I forgot to save the file. Okay, but so you should Google Silicon Valley Bank bank run. So you should get some pictures. People just line up in front of the Silicon Valley Bank's branch and trying to withdraw their cash, right? All right, and then so what we can do? Okay, so this is what skip these. So now these are the measurement the central bank or in general, so you can call it like the government has devised. Okay, so there are 4 regulations. Number 1 is called deposit insurance. What is deposit insurance? If you go to any legal bank in the United States, okay, over the counter means they have they are a counter, right? So you see the banker, right? So on any legal bank, usually they have a sign. The sign is usually look like this, like we are FDIC insured. What this means? It just means, say, for example, you deposit $10,000 in First National Bank, right? And then, so they are required, the banks required to buy insurance for the deposit you just made. And what does this insurance do? Just in case the bank in trouble. And then you can go to this FDIC, which is essentially the insurance company. They are going to give you $10,000. Is it clear? This is more or less works like your home insurance or your auto insurance. But this is for insurance. This is the insurance for your deposit. Right? So why they need that? It just make sure so each depositors, they are covered. Now, modern days, look at here. So these FDIC insured at least 250,000. So that's a lot, right? So if you look at data, okay. So how many of us have a saving of 250,000 in cash? Very, very few, right? I don't have that much money. But even though I have that much money, I probably just invest in either in a real estate or in stock market, right? So that just means with this FDIC, remember this is mandatory, right? Remember this is mandatory, meaning so for ordinary American, okay, so bank run is not an issue because for sure it's going to be insured, right? Except you really have more than 250,000 cash you deposit in the bank. If that's the case, you may nervous. All right. If you look at the data, if you look at the total saving, I think it's like between like 50 to 60% of the saving is insured. Okay, but you need to take that number very carefully. So that just means many people save. I mean, some of the savers, they have deposited more than 250,000. For that part, let's say someone has 1 million cash, right? Maybe like they need to like short term put in a bank. Like this happens, right? So for example, Berkshire Hathaway, so they have, I don't know how many cash they have, probably like 100 billion, something like that, right? Okay, so and then they put somewhere temporary. If that's the case, they put the bank is not able to insure that huge amount. Right? They only insure probably after up to 250. And then the amount above that's not insured. But if you look at the numbers of deposit, and the most is insured. Okay, so this is dealing with bank run. This is the first regulation. Now the second regulation is called capital requirement. What this means? It just means for a bank, remember, so the bank, how the bank work. So they get money from depositor, right? And then they use the depositor's money to make loans or investment. What is capital requirement? They just require the bank cannot solely work on the money from the saver, meaning they need to put their own money into the bank. And this is going to change the incentive of the owner of the bank. Why? Because now their own money is also in the bank. So they need to be a little bit careful. Just imagine if the money, 100% of the money coming, just imagine for the bank, 100% of the money coming from the owner, all right? Versus the case, 100% of the money of the bank coming from depositors. Under which case do you think the owner or the manager of the bank, under which case they are more responsible? When their money is in the bank, right? Okay, so because when the bank has trouble, they are going to lose their money. But in the other case, they don't care because when the bank is in trouble, so somebody is going to lose money, right? So this is the second requirement, capital requirement. But clearly, there's a trade-off. If the more capital is required, and then the size of the bank is getting smaller, right? But certainly they're getting safer, right? So they always have a trade-off. Third one, reserve requirement. That's something we already discussed. So that just means the fraction of the money the bank must set aside to prevent potential bank run. The higher the reserve ratio, the safer, but then the limited ability for the bank to what? To generate money supply. Now, discount window. So this is an arrangement. You can think about this as a market. Okay. So this is a market only for commercial bank. Just say if you give them a First National Bank, they have trouble. All right. And then, so what they can do, so they can borrow money from the Federal Reserve, okay, which is the central bank. Right. So those are the four things. So the central bank has established, trying to regulate or trying to mitigate the potential risk in our financial system. But you should always remember, in the first place, why we need a financial system, right? Just think about the two examples I give to you. Number one, if you have a project, now if there's no bank and the project is very risky, if you go to some individual investors, probably nobody's going to willing to lend to you. The bank, what the bank can do is, so they are going to pull all different projects together. Yes, for one project, the probability to fail is very high. But if you have 1,000 projects, everything fail, think about probability, it's almost zero, right? So that's how bank works. That's number one. Number two, the other example I'll give to you is just think about, now we suddenly reverse the course of the history. We live in a world, everything must pay with cash, with your saving. How your world is going to differ, right? Okay, so that's just why we need a financial system or why we need a bank, how bank help us. But clearly, so from the example show you a bank inherently generate risk, but that's a solution. But there's a delicate balance you need to strike. Oh, I do have the picture. Silicon Valley Bank. On the upper left, that's what happened in 2008, the financial crisis. On the upper right, they just happened just recently, like less than 2 months ago, right? Right, so here, so we can look at history to see how this money supply changed. 1929, 1933, sir. So you can see, so first you can see the currency in circulation. From 1929 to 1933, increased by 31%. What happens? What do you think? What happened? Why there are more cash in people's hands? They took it out, exactly. That's exactly what happens. They went to the bank, so they figured, so the safest place is my house. When they took it out from the bank, and now you can look at it here, checkable bank deposit, this decrease, right? And that's M1, overall M1 decrease. But now we enter this deflation, right? Because there's less money, the good sense, so deflation, meaning price level falls. So now in the recession, if there's deflation, what will happen? So deflation, when you face a deflation, are you willing to consume now or you want to postpone your consumption? Postpone, because in next year or in the future, it's going to cheaper. Why not I just wait? Now this is going to be a virtuous cycle, right? So that's going to depress the demand, aggregate demand. And then the economy is going to stay in a recession or getting deeper recession, right? But again, so in 1930, we don't have that wisdom, both in terms of fiscal policy and in terms of monetary policy. Fiscal policy. So in this situation, what are we supposed to do? We should stimulate, right? We should give people transfer, reduce tax, increase spending. But what President Hoover did, he wanted to balance the budget. How you balance the budget? You raise tax, reduce spending, right? That was a fiscal mistake. In terms of monetary policy, monetary mistake. And then now, so the Federal Reserve Bank or the central bank, they're supposed to loosening the monetary policy, meaning trying to generate more money supply. Instead, they tightening the monetary policy, meaning so generate less money supply. All right, so that's why in 1930, that was disaster. Again, so we did not have that wisdom, right? So now let's look at the modern Fed, right? So he is the current chairperson of the Federal Reserve Bank. When he speaks, when he speaks, the market trembles, right? So like yesterday, so they have a meeting regarding to whether they're going to raise the interest rate or not, right? And then so the market actually trembled. So if you look at the stock market today, so today down a lot because yesterday they decided to raise the interest rate. But then there are two questions. Number one, how the central bank raise interest rate? Okay, so when we say that, or when you read the news, it says, okay, the Federal Reserve Bank decide to raise the interest rate by 25 base point. Literally, how they achieve that? This is number one question. Number two question, why the change in interest rate has a profound impact on our broader economy? So those are two questions we need to understand to kind of finish this picture. That means in terms of money and the money supply, monetary policy, right? And before I move to the next slide, one more thing I want to highlight. When I say 25 base point, what does that mean? Does anyone know what base point means? So 25 base point literally translates into 0.25%. Okay, so that's what they say. So 100 base point is equal to 1%. Is it clear? Okay, so that's how they call this. What they call probably like a technical jargon, right? Okay, so the rest of the question is number one, how Fed literally change the interest rate or money supply, and second, how this interest rate change has impact on broader macroeconomy. Okay. So this is how the Federal Reserve Bank is divided, or as like structured, probably is better say. Here in DC, they have a board of governors. That's kind of a headquarters. And then so we have 12 regional banks. Like say for example, Omaha is right here, right? And this is Kansas. And then so there's a Kansas City Federal Reserve Bank. Right, so these regional banks, they oversight the economy in this yellow region. All right. So there are 12. And personally, I have visited 4 of them: Chicago Fed, Kansas City Fed, St. Louis Fed, Atlanta Fed. Like I go to St. Louis Fed quite frequently, and particularly in the summer to do research. Right. All right, so this is how they structure. Now let's see, so how the Federal Reserve Bank make the market tremble, right? So essentially they're going to work through this federal fund market, which is a market that allows banks to borrow from other banks. Okay, so essentially just say this is a market allows First National Bank to borrow from Wells Fargo whenever First National Bank need money, or when they have high influx of depositors who want to withdraw their cash. And then the other one is discount rate. The discount rate is red. The commercial bank borrow from central bank. Right? So basically, there are like 2 steps. When the bank is in a distress, meaning, say, for example, First National Bank, or think about Silicon Valley Bank. When Silicon Valley Bank has a huge demand of cash from their depositor or from their clients, Silicon Valley Bank has 2 steps to do. Number one, they can borrow from other banks, say, for example, Wells Fargo, Bank of America, Citibank, in this market, federal fund market, right? But clearly, so this interest rate, I mean, the borrowing cost is going to fluctuate, or it's going to determine by how many money available there. So this is the first step. Now, if in this market, they were not able to borrow, or they were not able to borrow enough or at a desirable rate, what they can do, they can go to the Federal Reserve. That is the last resort. So the Federal Reserve is going to offer them a discount rate. This is the rate the Fed is going to charge on the loan to a commercial bank. Right, so this is a two-step. Okay, so this two-step is what? It's kind of prevent. First, it's going to prevent the bank run or bank trouble. But secondly, so this two-step is going to matters. It's going to matters to the money generation. It's coming up, right? Right. So now I'm going to focus on the open market operation, right? I'm going to skip a few slides and I just go to the key part, right? Let's just go to the. Let's see. Okay, let me go to this part. Right. So now I'm going to focus on the open market operation. So essentially, this is going to explain to you how the Federal Reserve Bank changed the money supply. Right. So where we start, where we came from, a commercial bank has the ability to generate money supply. Right. You think of any bank, because when you deposit cash in the bank is going to keep a small fraction, and the rest is going to lend out. Right? And then so whoever took a loan is going to do the same thing. And then the other banks will do the same thing. That's how we generate money supply. Right? So that's the commercial bank side. Now to understand the central bank or to understand the bigger picture, we are going to focus on the central bank. First, let's look at central banks, the T account, assets and the liability. Right? This is a slightly different from commercial bank. For Federal Reserve Bank, their liability is a money base. Basically is what? Is the money they print. So when Federal Reserve Bank, they print out $1 trillion, right? So eventually it's go to circulation. But how they go to circulation? Like I mentioned earlier, usually they'll go to purchase treasury bill, right? So how that works? The Federal Reserve Bank literally print out a bunch of piece of papers. But in their practice, they can only print out one piece of paper. The piece of paper just says, okay, this is $1 trillion. But this is not for us to circulate, right? So anyway, so they're going to print out a bunch of piece of papers. And then, so this piece of paper will go to the hand of the Treasury Department. As a return, Treasury Department is going to give the Federal Reserve Bank some government debt. Now, in this account, what that means? So the Federal Reserve Bank has a piece of paper, shows what? Shows the Treasury Department's own is promised to pay $1 trillion to the Federal Reserve. Are you with me? Because this is a bond, right? Is it clear or no? So that's what the Federal Reserve Bank have, and then let's go to the asset, right? Because when the bond mature, what the Federal Reserve Bank can do, they can go to the Treasury Department, and the Treasury Department must pay them $1 trillion. Is that clear? Okay. Now, where the cash goes? The cash goes to Treasury Department, right? First, the Federal Reserve Bank print out a bunch of piece of papers, right? So this goes like $1 trillion. And then this bunch of papers goes to the Treasury Department. And the Treasury Department give the Federal Reserve Bank a certificate, which is the bond, right? So now this certificate goes to the asset side of Federal Reserve. Because when the bond mature, the Federal Reserve Bank can go to the Treasury Department, and the Treasury Department must pay $1 trillion as they promise. Are you guys with me? Okay. Now, on the other hand, the Treasury Department has a bunch of papers, right? But the paper just actually written says, okay, this is $100, $100, right? So, but the Treasury Department, remember, so this money So meaning, so whenever the Treasury Department need some resource, they can just come to the central bank. So in that sense, that's the liability of the central bank. In old days, basically what literally means is, so the Treasury Department, they can come to the Federal Reserve or ask the Federal Reserve to give them certain amount of gold. Put it simple way. Is it clear or no? Do you need me to draw a picture for that? All right. Okay. So this money, like currency in circulation. So that is a liability. Or just think about, so like if you have $100, like the dollar bill, right? In the old days, basically it means the Federal Reserve Bank is obliged to give you certain amount of gold whenever you want. So in that sense, that's a liability. It's clear. But on top of currency in circulation, there are bank reserves. Remember, for the bank, for each $1 or maybe $1,000 deposit they have, they need to set aside $100, right? But in practice, so the commercial bank, like First National Bank, they won't keep this $100 cash in-house. Usually what they're going to do, they're going to deposit in the central bank, and the central bank give them a small interest rate. Is it clear? There's lots of information. So that in that means, so the bank reserve is also a liability, because like commercial bank has a deposit in central bank. When commercial bank need money, they go to the Federal Reserve and to withdraw the cash. Is it clear? Okay. So this is a liability and assets for Federal Reserve, right? So if we understand that, now everything becomes straightforward to see how the central bank, which is Federal Reserve Bank in the United States, how they can change money supply, right? So let's just start with increase money supply, okay? If they want to increase money supply, what the Federal Reserve Bank is going to do? The Federal Reserve Bank is going to purchase some bond. Okay, look at here. So on the top, this is the Federal Reserve Bank, right? So Federal Reserve Bank currently they have a liability of 100 millions, and then their assets is in Treasury bill. For the commercial bank, so they have 100 reserve. Actually, this reserve here, this reserve actually goes here. Or that's where the liability coming from. The commercial bank deposited 100 millions in the central bank. All right, it's clear. Okay. So now if the central bank decides to purchase some treasury bills, wait a second. Oh, this is sale. Sorry. If the central bank they want to purchase some treasury bill, right? And then so how they're going to do? So usually first there are two parts. Number one, they are going to purchase from the Federal Reserve Bank. They are going to purchase from commercial bank. Usually they're not directly from the Treasury Department. But yes, they can purchase directly from Treasury Department. But most of the case, they just purchase from commercial bank. The commercial bank, they also invest in treasury bill, right? So now if the Federal Reserve Bank purchase some treasury bill from commercial bank, how they're going to pay? And literally the way to pay is just give the commercial bank some reserve. That's how it is. If you look at a commercial bank, so they break even. So basically for the commercial bank, treasury bill becomes reserve. Okay, nothing else happened, right? So basically this commercial bank, so their assets swapped from treasury bill they used to have to reserve. All right, now let's look at central bank. For central bank, they start with no treasury bill, no liability. Now they are going to have a liability because now they are going to give the commercial bank $100 million of reserve. As a return, the commercial bank gives the Federal Reserve 100 million of treasury bill. Is it clear? Let me say it again. So when this open market purchase begins, okay, so maybe just draw a different picture, it's probably better. When the story begins, let's clear here. When the story begins, so we have a commercial bank, let's just C, okay, COM, okay, commercial bank. And then on the right-hand side, you have Fed, Federal Reserve Bank, okay? When the story starts, the commercial bank has they have some bond, let's call it 100 million. Okay, so they have 100 million of bond, which is their assets. All right, so this is called a bond. So this bond just give the commercial bank some investment opportunity, right? Is that clear? Okay, when the story starts, so Fed has nothing. Let's just start with a simple case. Now, when the Fed want to increase money supply, what the Fed is going to do? So they are going to buy this bond. This bond will go to Federal Reserve Bank. But that's how the Federal Reserve Bank is going to pay for this bond. Because now commercial bank has no bond, right? So the Fed is going to have $100 million of bond. Meaning, so when the bonds mature, so the Fed can go to the Treasury Department to get $100 million. Is it clear or no? Now the question is how the Fed is going to pay for this $100 million of bond. Right, so that's the reserve kicks in. So technically or like in practice, so the Fed, it just changed the account of the commercial bank. So now the commercial bank suddenly has 100 million reserve. 100 million of reserve, let's call R. You can think about, so what happens is for the for the commercial bank, just think about First National Bank. So suddenly they have $100 million of deposit in the central bank. Is it clear? Now, how this is going to generate money supply? So the commercial bank has some reserve or has some deposit in Federal Reserve Bank suddenly, right? Because they give up their bond. Do you think the commercial bank is going to sit on this cash? What are they going to do? Loan it out, right? Why they loan it out? Because remember, so the story is they have a reserve ratio, right? Because they don't need this reserve. Because this reserve is going to earn them like almost zero interest. And what they're going to do is they're going to use this money to lend to small business, to lend like homeowners, make an interest rate of like 5 to 10%, right? So if they loan out, and then the story we just discussed, or we came from, start to play, right? Now the money starts to generate. Does it make sense? Okay, so this is how the Fed create money supply. So technically, they just purchase some financial assets from commercial bank. That's it. Because by purchasing financial assets from commercial bank, as a return, they give commercial bank some reserve, but technically it's like a deposit. And then the commercial bank is not going to sit on those deposits. They're going to lend out. When they start to lend out, and then the economy starts booming. Right now, let me just take you something a little bit more strange or more subtle issue. Like during the recent recession, like particularly like COVID-19, right? So some of the commercial bank, even though they have a huge reserve, they did not lend out. But this will be strange. Why they did not lend out is because they did not find some good investment opportunity. So that's a partially explain what Silicon Valley Bank did. Okay, so instead of lend out, they should purchase treasury bill. Okay, this will be too advanced. Let's just focus on now. Is it clear? So this is how the central bank create money. Basically, they buy financial assets. Once they buy financial assets, commercial bank get deposit, reserve. Once commercial bank get this reserve, then can start to make loans. Is it clear? All right, so now the central bank, they can reverse the course, right? So instead of buy treasury bill, what happens if they sell treasury bill? They give you 1 minute to think about. Okay, so what happens if they sell treasury bill? So this literally happening now. Okay, since the end of 2020. So Treasury, that's right, Federal Reserve started to sell treasury bill. Okay, let's go step by step. If the if the Federal Reserve Bank, which is the central bank, start to sell treasury bill, first of all, who's going to buy? Who has the capacity to buy? We are talking about billions of the treasury bill. Are you going to buy? You don't have $1 billion. Who's going to buy? The bank, usually a bank, right? Okay. So, but the bank, if they want to buy treasury bill, how they're going to pay? Their reserve. That means technically it's not reserve. It means so they are going to. So if they decide to buy, they're going to squeeze their investment, and then it's like reserve, right? Okay, very good. So yeah, in a simple way, you can think about they just use their reserve. Now, if the commercial bank use their reserve to buy treasury bill from Federal Reserve, what does that mean? The amount of loan the commercial bank can make, it must get squeezed, right? Because they have to satisfy the reserve ratio, right? And then they must tighten in the loan so that they have enough reserve. Does that make sense? So if that's the case, what happened to the money supply? It's going to tighten, right? That's very simple. That's very simple. Okay. So let me just, now we can just look at the slides. All right, so this is when Fed purchase treasury bill. All right. And then this is when Fed sells treasury bill. Now look at the Fed side. So both their assets and the liability is going to decrease, right? Because they don't have this treasury bill anymore. And also they don't own commercial bank, this $100 million either. Now, what happened to commercial bank? For commercial bank, their asset side changed. So basically the asset side changed from reserve to treasury bill. But then there's law requires the commercial bank to maintain certain reserve, right? And how they can maintain their reserve, they must cut their lending. They must keep certain amount of money. If they do that, and then suddenly the money supply is going to shrink, right? So this is how the Fed is going to change. Right, so this is how the Fed is going to change money supply, right? By the way, here's the question: where does the Fed get the fund to purchase U.S. Treasury bill from bank? Like I just explained to you, so essentially they just change their account, like on the computer. But certainly, yes, the alternative is what? They just order the mint company. Like say, for example, in Denver, there's like a minting company. So I don't know if any of you visit there. In downtown Denver, there's a factory. So basically, they just print out money. Has anyone ever visited there? No, you did, right? So you can take a look, right? So that's like huge glosses. You can see how they print out money. Oh, okay. So you've been there when you were young, but you know what I'm talking about, right? Okay. So technically, I mean, alternatively, what the Fed can do is they can order this company to print many papers, which is like $100 bill, and then use these print out papers to buy treasury bill, right? With some little cost. What is the cost? First, they need to print, right? I don't know how much does it cost to print. And second, they need to transport. First, I guess they need to transport from Denver to DC and from DC to like New York or San Francisco. Does that make sense? Okay, but still, the cost is almost zero compared to, like, say, for example, you generate $1 trillion of cash, right? But this is probably easier. So basically, they just change your account on the computer, on their computer system, right? So summarize, look at here. If the Fed want to increase money supply, they buy treasury bill. If they want to sell the decreased money supply, they sell. Right? Let's see how this works. When Fed buy treasury bill, short for T-bill, Fed basically electronically increase the reserve of the seller, meaning commercial bank. Okay. Now the commercial bank has more reserve, or you can see what have a bit more deposit in central bank. What they can do, so they're going to lend out more. All right. So there are more money floating around in our economy. And on the other hand, if the Fed wants to decrease money supply, it's going to sell T-bills. And then, so the reserve of the buyers, meaning the commercial bank, is going to decrease because they have to use their deposit in the central bank to pay for the financial assets they purchased from the central bank. Now, with fewer reserve, they must reduce and squeeze the loan so that they can satisfy the reserve ratio. And hence, the ability for the bank to generate money is going to decrease, right? It's very simple. This is how central bank changed the money supply. But now since 2008, the financial crisis, okay, the Fed becomes more innovative, but certainly become more risky. Not only they buy these treasury bills, they also buy many other different financial assets. Like, say, for example, at some point they even buy like stocks, right? But certainly, so it's more convenient for them. I mean, they can stimulate the economy further. Just imagine why this matters. Just imagine if the money supply is such that interest rate is so low, close to zero, right? And then technically, really, you cannot push the interest rate further, right? Can you imagine if the interest rate is negative? Do you want to deposit money in the bank? No, right? Yes, it happens in some country, like in Europe, in some country, the interest rates can be negative, but it cannot be too negative. Maybe like a 0.5% or maximum -1%, right? So if you go to like a -2%, no one's going to deposit money. I'm willing to risk putting the cash in my house, right? Okay, so you can see there's a limit for what the Fed can do using this approach. The limit is when interest rate goes to zero. It happened during the financial crisis. And then the Fed come out some very innovative approach, but certainly inherently it creates some risk. Okay. Right now, let's look at this practice question. Suppose this is the only bank, and all money is held in this bank, I mean, in this economy. There are no excess reserve. Certainly, no one willing to sit on cash without making any profit, right? If the Fed makes an open market sale of 50 worth of T-bill to the bank, what happened to the money supply after all adjustment made? Meaning, after all this multiplier effect applies, meaning so the bank lent out and someone took the loan either use cash to like somebody else or deposit in another bank, and then so on and so forth. Right? So how the money supply is going to change? First of all, it's going to increase or decrease. Right, it's going to decrease. The Fed sells 50 billion treasury bill. Very good. Now decrease by how much? We need to find out the multiplier. What is the multiplier? But before we find out the multiplier, let's find out what is the reserve ratio. $1,000 deposit, required reserve is 100. What is the reserve ratio? For each $1, you need to set aside how much? What is the reserve ratio? 10%. So if the 10% is the reserve ratio, what is the multiplier? 1 over reserve ratio, that's how we generate money supply, right? Meaning so the multiplier is 10. Meaning so for $1, the bank attract, and eventually it's going to generate $10, right? So now the Fed is going to sock away $50 from the bank. And then, so the bank is losing the ability of how much money they are going to lose in terms of money generation. It's 50 times 10. Clear? So hence the answer is D. So C is how the Fed can play the magic. Right? So they sock away $50 from the economy. And then the money supply is going to decrease by 500. Right. Now the last part is the question how the Fed implement a monetary policy so that they can move in the interest rate to affect aggregate output. There are two questions. Number one question, this is what we are going to focus on. So how the Fed affect interest rate. For the moment, I only explain to you how Fed affect money supply, right? But money supply is different from interest rate. So this is what we're going to learn. Now, the other question is, if the Fed can effectively change interest rate, how that's going to affect aggregate output. Let's start with the second one as the easier one. If interest rate rise, how would that affect your consumption and investment? Let me give you an example. If the interest rate increase from, say, for example, 5% to 30%, are you willing to take a loan to buy a house? No, you probably stop to come to college, right? If the student loan is like 30%, right? So higher interest rate, lower incentive to consume and invest. And what happens to the aggregate output? It's going to fall. On the other hand, if interest rate is very low, 0%, this is usually what we've seen, right? So there's like car dealership says, okay, so you're going to have a sign-up bonus plus a 0 interest for 5 years. So that's how they attract buyers, right? So certainly this interest rate eventually is going to be controlled or manipulated by the central bank, which is Fed. Now, the only remaining question is how the Fed is going to affect interest rate. All right. Okay, so we kind of run out of time. Let me go quick. So here, still we are like a supply and demand. For the supply is simple. Supply is what we just discussed, right? And so in some sense, like controlled by this Fed. Now the key is demand. So the demand for money. So why you need money, right? So basically there's a cost. Let me just go straight. Go to the demand curve, right? The interest rate on the vertical line, horizontal line is the demand, quantity of money. So usually the higher interest rate, the lower quantity of money you demand. Lower the interest rate, the higher quantity you demand. Why is that? Just think about the opportunity cost. If you can earn 10% of interest on the money you put in the bank, are you going to keep that as cash? No. If it's like saving interest rate only 0%, do you care? You want to put it in the bank? I don't care, right? So that's clear as expense. So why higher the interest rate, the lower money you want to cash around with you, because you're losing the opportunity cost, or you're losing the opportunity to earn interest from the bank. On the other hand, if interest rate is very low, and then so you prefer carry cash because that's easy, right? So this is money. So this is money demand. Now, what is the money supply? Money supply. Let's just skip these. So that's money supply. So money supply is vertical. This is because that's the choice of the central bank, right? So actually, literally, the central bank is trying to change the money supply, so that it's going to effectively affect the interest rate. All right, so this is a policy choice of the central bank. Now, clearly, from this diagram, the supply and demand is going to determine two things. One is the interest rate, the other is money supply. Right? So, but now clearly, so from this diagram, you can see if the Fed increase, now let's go to here. If the Fed increase money supply, and then interest rate is going to fall. It's going to fall. Right? On the other hand, if the Fed decrease the money supply, the interest rate is going to rise. Right? So, but then how, remember where we came from, how the Fed can change money supply. Right? So essentially they just buy or sell treasury bill. So now we put everything together. So when Fed says, I'm going to change interest rate. Okay, so technically, so they are going to, technically what they are going to do is they are going to change the money supply until they reach this interest rate level. But then, so this is going to have a cascading effect on the economy, because interest rate is going to matter to your consumption and investment. All right? So that's how the Fed do business. But clearly, okay, so when and which direction, so when the Fed want to change the interest rate and to which direction, that is going to depend on the state of the economy. Same example, the economy is in a recession, and usually means unemployment is high, right? And the price level falls. So do you think the Fed want to increase money supply or decrease money supply? What do you think? Huh? Increase money supply. By increasing money supply, they reduce the interest rate, right? Reduce interest rate, encourage consumption and investment, right? Okay, on the other hand, so if our economy is in the expansion mode, and then naturally, so the Fed want to reduce money supply to raise the interest rate, right? To slow down the economy. All right. So finally, one thing I want to highlight is so the difference between monetary policy and fiscal policy. So monetary policy usually move much faster. Remember, there's a lag in fiscal policy, right? Because at the end, so you need to what? You need to make sure so the resource go to the bottom of our economy, right? But here, if the Fed, so I mean, what the Fed can do is very quick, right? So basically, they just change the number on their computer system. Certainly, they need to have high security. Otherwise, people are going to hack into their computer. Right? So once they make change, and then so the money supply is going to change, interest rate is going to change, and instantaneously everyone feel the pain or feel the joy. Does that make sense? Because instantaneously, so if you go to the bank, it's like you go to the gas station. When the oil price change, and then so the gas station is going to change the change their gas price, right? Similar here. So when Fed moves, okay, so instantaneously, so the interest rate, like go to retail bank or go to mortgage, it's going to change instantaneously. If any of you ever have experience to get a mortgage loan, right? And you probably heard the term. So the bank always asks you or persuade you to lock the interest rate. Have you heard about this term? Does anyone have any experience to take a mortgage loan? Or maybe you can talk to your parents. So usually, so they are going to persuade you to lock the interest rate, like in a week or in a month. Why? Because interest rate is adjusting. And why this is adjusting? Because there's the central bank is kind of controlling everything, but plus the market, right? Because this is like a game. So the central bank is going to make their move depending on the state of the economy, right? But then, so the state of the economy is coming from what? Coming from each of us, our decision. But where our decision, when we make our decision, it's going to based on what? Based on the policy, right? Does that make sense? Right. So you can see, so this like a chicken, egg, probably no. So I don't know what's the best term. So to summarize, so the central bank, when they do their decision, they are going to see how households respond. But when households make the decision, they want to focus what the central bank or the government is going to do. Right. So you can see there's like a back and forth. But certainly, so in reality, you're going to see the fluctuation.